All right, we're going to do a quick root video per request. I've already checked the company out before. It has, the stock's been dropping a lot compared to some of the other growth stocks. This is sort of their main website. They provide insurance, um, mostly car insurance, but it's kind of like a new way for people to not get just shoved into a demographic and given a rate. It's customized, kind of like how Oscar Health is hoping to do for health insurance. So I use Stock Unlock. You can look at the main page, see it's a pretty small company. Has a huge free cash flow yield of 15%, which I'm normally pretty excited about. Price to sales is under 1, which is also something that's pretty nice to see, just quickly eyeballing this. Um, on this page, you can also see like similar-ish companies, but we're just going to focus on Root today. So, first thing I like to look at is total revenue, cash from operating activities. Um, you can see that there was a lot of losses in the past, and as revenue has skyrocketed, about 2023, the end of the year, they started making positive operating cash flow. I'm still using operating cash flow for this company because they have a decent amount of stock-based compensation. You're still going to want to go manually take it out, but I just like to use that. You can use earnings later on in life. I probably wouldn't use it right now because I don't think that they're focused on profitability. So let's zoom into when they started to sort of change the picture here. And you'll note that there's like a huge, massive average growth to revenue on a compounded annual growth rate alongside cash from operating activities. We can switch it to earnings here and see that they are technically um, just became profitable, which is nice. Looking at stock-based compensation, you also really want to see this. It is dropping, which is great. You don't need to give as much compensation if the stock's going up. Also, cash bonuses are great. You just really don't want to over dilute your shareholders. So here you can easily just check that free cash flow out compared. It's not a huge amount, but it is substantial. So one thing I like to do for all of these companies is I already had this filled out, but we're going to use free cash flow here just because it's simple and there's not enough history of free cash flow for us to get averages. So I thought it would be a little fun to just um, try to make the fair value of today. So if the stock price is around $79, the market is currently pricing in a 5-year free cash flow growth rate of 12.8% with this amount of share dilution, no dividend, and a multiple of only 8, which will be low if they continue to grow the way that I was just showing. Um, so this is sort of how I begin my margin of safety analysis. So if this is actually going to go up, let's say they grow at 18% instead, and that the market decides to give them a multiple of 12, you suddenly have a much higher current price for the fair value and a much higher future price. As you get more bullish, obviously the price goes way, way up, but there's a lot of factors to take into account. But you can see that the market's pretty bearish on the company based on the first numbers that I showed. And you can, of course, switch it to whatever you want. This is an interesting setup here. I don't know everything about insurance, but looking through their key performance indicators, I was pretty interested in their net loss ratio, which is something you should always be looking at. You can see that they were actually really losing a ton of money initially, and they've continued to reduce this number. 66% is great. Health insurance is generally a lot higher than this. So it's nice that other types of insurance don't have such terrible loss ratios. And at the same time, in 2023, their direct premiums written have increased. So clearly, they're getting customers and they're providing business while they're also cutting their expenses down and their losses down. And another thing you can do to see that, which is what I normally do, is you can hit a gross operating and net margin and you can see, is it, let's get rid of gross margin. Is it climbing? Is it positive? It is climbing, and it's usually coincides with the loss ratios going down. Obviously, these wouldn't be positive if the company was not profitable. Um, it doesn't look terrible so far. Going back to the review screen, a forward PE of 30 for something that had 1,000% earnings growth is interesting. And then the current PE is only 15. But this is generally, I'm just a lot more interested in free cash flow yield. That's one of my favorite metrics to use. So if they were to just take all of their free cash flow and provide no stock-based compensation, no capex or anything, they would be able to provide a 15% dividend per year, which means they're cash flowing pretty nicely based on their market cap. Going over to the chart like we always do, had a major drawdown. So at one point they were down 62%, which is pretty brutal. You can see that the volatility is resets. It's still pretty low. The darker the color and the lower it is, the lower the average volatility is here. Volume's kind of hanging out, not doing a lot. Does actually look like it uptick a bit here. But I drew a demand zone and we're right in it. It's actually held. So I believe this candle is a really strong weekly demand zone. Um, it was a capitulatory candle right before a massive uptrend. And these tend to be retested, and we're retesting it now. So chart-wise, I would be interested in this as a trade. I don't know enough about the company to feel comfortable adding it to my risk account, but it's definitely intriguing, especially because of this. I really like to see this decline in loss with a revenue growth that's huge like this. So clearly they're solving some sort of problem, but definitely something to add to the watch list and to research further. For me, it's neutral right now. If I were to just be using a couple of the financial metric charts, I'd probably say it's a buy, from my personal opinion. But let me know what you think.